Hello, and welcome to Crypto Simulation Theory. Today we're going to talk about risk management, part 1, the investor mindset. This is part of a 4-part series to teach you the best way to navigate the crypto markets while minimizing your overall risk and maximizing your gains. Nothing that I tell you in this video is intended to be financial advice. It is purely for entertainment and educational purposes only. You and you alone are responsible for your financial decisions. Be sure to check out my social links. I have a Telegram, the Snake Pit. On TikTok as the Gaussian Snake, and on Twitter or X as the Gaussian Snake. And so I want to talk to you about the 5 principles of successful risk management. And these are divided up into 5 categories: emotional and psychological self-awareness, commitment to a risk profile, financial awareness and discipline, balancing patience and decisiveness, and self-confidence and positive thinking. So investing in the crypto space automatically assumes a higher risk than participating in other places like the stock market, precious metals, real estate, because crypto is speculative, it's unregulated, and it's loaded with scams and bad actors. As many as like 99% of the projects out there are scams, rugs, initiated by VCs or other bad actors that do not have your best interest in mind. Because of this high risk, you do also have the opportunity to earn life-changing gains and financial self-sovereignty in a fraction of the time it would take to do in traditional finance. So it's a little bit of a trade-off between the two. But unfortunately, most people, like around 99% of people actually, they're going to lose more than they make in this market because they're going to make key mistakes that go against the principles that I'm going to teach you. Even some educated and very experienced investors from other spaces can find themselves down very quickly in this space because it is a zero-sum game. To be successful, you have to understand that this game will test you in ways you've never imagined. There's no way to simulate it either. You could try simulating trades. There's nothing like having your money in the space and having everything at stake like that. Even though crypto investing is a player versus player game, a zero-sum game, it's more so a game against yourself. You are battling with your emotions, and if you can't get a handle on those, then you will not be successful in this space. And just to give you an idea of the variety of emotions that you might experience in a typical market cycle, I bring up the Wall Street cheat sheet, which kind of goes through the psychology of a market cycle. Now, I am going to do a separate video on market psychology, but just to kind of go through the different emotions you might feel, you start with disbelief, progress to hope, optimism, belief, thrill, euphoria, complacency, anxiety, denial, panic, capitulation, anger, depression, back to disbelief. And this just repeats over and over again. The charts are a visualization in real time of human behavior. Okay, your behavior, the behavior of people around you. So you have to have your senses tuned in to what's going on around you, and you have to be able to understand what you're looking at on a chart. So I want to talk about how to understand what your risk profile is, and you may not know what it is, but you do need to define it if you want to be successful in this market. You need to decide what amount of risk you're willing to take, how much money you can afford to lose, and you need to stick to that plan, because if you just waffle around between one and another, you're going to get wrecked. So I made up this chart for you with the hopes that it would help you to identify your risk profile. And so we have on the left a low risk profile. Somebody, in my opinion, with a low risk profile, keep in mind we're all in crypto, so our risk profile, as I mentioned, is higher than nearly any other space. But that would be somebody who's a Bitcoin maxi and holds only Bitcoin, because Bitcoin has been around since the inception of the crypto space around 2009, and there is no safer asset in the space than Bitcoin. During a bear market, if you're going to hold anything, you want to hold Bitcoin. And during a bull market, Bitcoin tends to lead the way and also provides outsized gains compared to many other projects. Even though there will be tons of projects that will outperform Bitcoin, Bitcoin still does relatively well. And a very low risk entry and exit strategy is to have a carefully planned DCA entry and exit, meaning that you could write it up on a spreadsheet if you wanted to. You could have it laid out really nicely. But if you're going to be a low risk investor, then you need to have a clearly defined plan to get your Bitcoin during the bear market and also during undervalued dips, and then also to sell your Bitcoin when you are ready to. And a low risk investor might hold on to their Bitcoin. They might have a HODL stack where they don't sell it for maybe a decade at a time or something like that. That would also be considered not quite as low risk. You might think it is, but because we don't know if Bitcoin will even be around in 10 years. I mean, I think it will, but that could actually be a higher form of risk. But a truly low risk investor is going to have an extremely clearly defined plan and stick mainly to Bitcoin. Not saying they wouldn't have any Ethereum. If they were going to pick up a second one, it would probably be Ethereum. So we could throw Ethereum into there. Since Ethereum is also an established blue chip, I would say that you can make an argument that's a low risk investor, even if they hold both. Now, a mild risk profile would be somebody who holds both Bitcoin and Ethereum, maybe just the two of those. And they might even have some of the older altcoins that have proven themselves across different cycles, which there aren't that many of, but there's certainly more this time than there were last time. And they'll have a very carefully planned rotation of capital, meaning that they'll ride up the Bitcoin mania, rotate out those profits to altcoins and Ethereum, and then they'll ride up the Ethereum and altcoin wave and rotate some of that back into Bitcoin and cash. And their strategy is very carefully planned, meticulous, know exactly how they're coming in and how they're going to exit. Okay, then we move up the risk curve to a moderate investor, moderate risk profile. And these are going to be people who hold Bitcoin, Ethereum, large and mid cap altcoins. We're probably going to stay away from small caps. So what is a large cap? What is a mid cap altcoin? That definition varies wildly. So I'm going to say a large cap alt is going to be one that has a valuation of around 8 or 10 billion or more. Mid cap altcoins, I would say around $1 billion or more, maybe even 500 million. See, the definition of this does vary. And they're going to also have a very carefully planned rotation and DCA entry and exit. However, they may take some chances and do some lump sum buys. Lump sum buys in crypto are more risky than DCA entries, but they can also be more profitable if you time your entry or your exit, lump sum exits too, I should say, if you time those well. But they tend to not do too much of that. They tend to prefer the DCA approach or dollar cost average. A risky risk profile would be somebody who may have some Bitcoin or Ethereum, but is mostly focused on obtaining altcoins, including small cap alts. And these could be even micro cap alts too. So we're talking altcoins with a market cap below 500 million and possibly as low as several $100,000. And this person may also have more of a fast and loose entry and exit strategy, getting into something quick because these small caps and these micro caps can move very rapidly. They might hold small caps for a while, and they might also participate in very complicated into the weeds DeFi plays because they can make more money that way. They may participate in liquidity pools and take on the more risky but rewarding part of the crypto simulation. And then finally, we have a high risk profile, which is somebody who's just maybe 100% degen into altcoins, NFTs, and other high risk plays. And they may also participate in leverage trading and have kind of a YOLO attitude. You only live once and ape in and out of the market at random. And you know, which one of these strategies is the best? The truth is they can all work out very well. You know, any crypto YouTuber who tells you one of these is better than the other, they're wrong. No, you have to pick the one that is best for your risk profile. If you are a risk-taking person and you need that adrenaline rush, why would you take on a low risk profile? The market is going to bore you. If you're somebody who's very conservative financially and can't really afford to take a lot of risk, you'd be out of your mind to take on one of the more risky types of risk profiles. So you absolutely must know yourself and what you can handle. And if you're not sure, take a look at your life. What kind of life do you live? Are you the kind of person that jumps out of planes, you know, does skydiving and all kinds of crazy stuff because you need that adrenaline rush? I'm not sure the low risk profile is going to be the right one for you. Or are you somebody who counts every penny and is worried about your retirement and can't really afford to gamble with too much money? You're probably better off with a lower mild risk profile. And that brings me to the next question, which is, well, what kind of holder are you? So we've talked about risk and how you approach that, but how do you approach holding your projects? And so we have a variety of different kinds of holders. And these don't necessarily have to correlate to the type of risk. I think some of them do, but I'm going to kind of call them out and isolate them. We have the long-term holder. This is somebody who will hodl their Bitcoin and Ethereum and maybe some major cap altcoins through several cycles, and they won't sell. I've heard some people saying they'll never sell. I don't understand that at all, because don't you want your digital assets to actually have some realized value in life? I don't know, really. You can't. I said this in my Telegram chat, but you can't live in an altcoin. You certainly can't drive a Bitcoin, and you can't get married and have children with Ethereum. So the long-term trader is somebody who would only sell a major mania topping process. So this is somebody who buys in during the bear market. They may DCA in throughout the early bull stages, crypto spring, buying dips, but they will not sell any of their bags and maybe not even take profits until extreme mania sets in and they feel like a certain risk level has been triggered and they're ready to pull their money out. You have momentum traders. These people sell major peaks, they take in profits and reinvest in undervalued projects. I feel like this is probably the majority of the crypto space, and this is the type of trader that I am. I'm a momentum trader. So I will take profits sometimes. I will scrape profits off or pull out my initial investment, but there's also projects that I'll just hold for the whole cycle. So I have some projects that I do consider a long-term hold and other ones that are more momentum based. And I'll kind of hop in and out of projects, but not super frequently. Then you have your swing trader. Now this doesn't have to be somebody who's selling and buying stuff every single day. Okay, you do have your canonical swing trader who is that, day trader person, and that's a career for them. But you can have people swinging in and out of stuff every week, every month. And so it's sort of like, well, where's the line drawn between a momentum trader and a swing trader? I think you can define that for yourself. But I would imagine a swing trader is making more frequent trades on much shorter time frames. And finally, the most active kind of trader, it would be maybe a combination of these two, but somebody who's engaging in leverage trading, which is opening very risky short and long positions. I personally don't ever participate in that and never have, never will. Not many things I'd say never on, but that's one of them. I think it's just too easy to spot. The blockchain is open, right? And so we have liquidation hunters, and if you're on the wrong side of that, even if the market is going to go up, it could dump first and then go up. And you get margin called, and yeah. But I'm not going to criticize people for whom leverage trading makes sense, because that fits within their type of holder and risk profile. One of the most difficult things to do in crypto is to figure out how to balance patience and decisiveness, because patience is not always rewarded in crypto. Sometimes patience is actually punished in crypto. But something to keep in mind, most assets will spend very little time going up. And when I say going up, I mean going up in a mania kind of way, like this kind of way. And by the way, this is Aerodrome, or Arrow. Borrowed this today from today's price action. But most of the time, if you look at any chart, really, crypto assets can spend months, years in very boring sideways price action. And that sideways price action may have some bumps and some valleys along the way, but overall it's just boring. And that's just something you need to live with if you want to realize gains. You have to accept that these mania periods are very brief. They don't last for that long. And capitulations are also brief, and they don't last for that long. So if you're going to stick around in the crypto simulation for long enough, you'll find yourself bored at times with the assets that you hold. So it's important to find other things to do so you don't get impatient with assets that are valuable, but they just haven't moved in a while. And if an asset has just moved and it has gone up, you should not expect that it's going to do that again anytime soon. It could be months before that happens, even in a bull cycle. Okay, that being said, if you're researching projects and you find one that you really like and it has a super low market cap, sometimes you need to act quickly, okay, especially on micro caps and small market cap coins, because they can move super fast, and this is where a DCA approach might not work out too well. I tend to lump sum with micro caps and small market caps. You want to, of course, if you're not very high on the risk curve, you want to keep that to a pretty small percentage of your overall portfolio. Okay, and we can talk about portfolio percentages too, but that's something I would probably include more with my risk metric video, to get into stuff like the Sharpe ratio and Sortino ratio, things like that. And I don't really know how into the weeds I really want to get with that, because you can overthink it too. I'm going to talk about it a little bit here as well, but sometimes you do need to act very quickly. And if you wait a day or even wait an hour, you could miss out on a 2x or 3x. This has actually happened to me. I found a project last year called Shrapnel, which is a Web3 play-to-earn game. When I saw it, it was at 12 cents. 12 cents. But by the time I got everything on Uniswap to work and I got my money where it needed to be, it was already up at 16 cents, 17 cents. And I DCA'd. I mean, I did do a lump sum into it, pretty large lump sum. And then I just wanted to put in more money, but I was indecisive about it. And I ended up watching the price just get ahead of me. And I ended up just kind of sitting it out. And ended up selling that project. But that's just an example of how patience doesn't always pay off. Also, if a project has pumped a significant amount and everybody's talking about it, and you go and chase those gains, it's going to get you wrecked. Okay? You have to train yourself, and this is something we can talk about in the market psychology video as well, but you have to train yourself not to fall for the FOMO. There will be other opportunities. There is more than one path to wealth. There is more than one path, and if you're going to get on the path that everybody else is currently on and making those gains, and you're going to be their exit liquidity, you're going to be the person they dump on. And not only that, but if a project is pumping and you do get in to make some money, what are you going to make? Like a 2x on something that somebody's made 30x? Go for the undervalued and boring crypto assets that people are talking smack about, but you know they have a solid community, they have solid fundamentals, and a use case. And so for me, those projects have been Dogecoin and Polygon, mainly Polygon. I don't really have a lot of Dogecoin, but I have a tiny amount. But Polygon has been a big hold for me, and it hasn't done anything in a really long time. People are fudding on it. They're saying Polygon's going nowhere, but I know better than that. I'm deeply integrated in the community. Polygon is going somewhere. And by the time it does go somewhere, guess what? Everyone's going to be like, oh, Polygon's the best thing. It's taking over the crypto space. And by the time people are talking about it in a really positive way, that's the time to turn off the DCA faucet. Okay, so this is really important. You're watching me because you're looking for guidance, and I think that that's a great thing. And I do have a particular skill set. I am very skilled with market psychology, chart analysis, and that sort of thing. But I cannot tell you how you should play this market, and you shouldn't look to me to make those decisions for you. Self-confidence is one of the most important things in the crypto simulation. YouTube and crypto Twitter personalities like myself, the Gaussian snake, we are not infallible. We make mistakes. We have bias. We are not to be fully trusted. Nobody understands this market perfectly. I don't understand this market perfectly. I get a lot of things right, but if you look back at my videos, I've gotten a few things wrong. So anybody who claims that they can perfectly understand this market is full of it. They're lying. You need to develop your own intuition and learn to read charts. You can read charts, and we can do a video on that at some point where I can teach you how to do some very basic TA on your own, analyze fundamentals of a project, and trust your gut. Nobody can or should navigate this market for you. And the way I want you to think about this, because when you're buying digital assets, you don't really necessarily understand what you're throwing your money at. But if you were going to buy a brand new car or buy a house, would you just throw money at it without even test driving the car, seeing what the car looks like, making sure that they're reliable, talking to people about it? Would you go just randomly buy a house online without even looking at it and looking at the neighborhood? So why should crypto projects be any different? Why shouldn't you do research? Would you listen to someone else? Would you listen to a crypto YouTube personality like me tell you what kind of car to buy or what kind of house to buy? No, you wouldn't do that. You should listen to more than one crypto personality. You shouldn't only listen to me. You should listen to other people as well, including people who might disagree with me, but you have to make up your own mind, and that is so important. There's so much brainwashing in this space done by crypto influencers who are trying to pump their own bags, and I think that's an abuse of the position that we're in. I'll FUD my own bags if I feel like there's something wrong with the project, and if I do talk about projects that I hold and why I like them, I'm going to give you a lot of reasons for it. But there's influencers who do that. There are also projects that do that with the glitz and glam and all the little psychological tricks. I've seen, these airdrop, the airdrop psychology where they're giving you all this free stuff. Personally, I tend to stay away from those projects, but a lot of people like them and they get drawn to them for good reasons. It's good marketing. If you have self-confidence, you'll know exactly what your investing thesis is. You'll know who to trust, and you better as heck trust yourself, because you're the one who hits that buy and sell button. I can't hit it for you. You hit it yourself. Speaking of which, positive thinking. You may not realize this, and I'm not saying toxic positivity, okay? It's okay to be negative sometimes. It is. By the way, anything I'm telling you is not professional therapy or anything like this. These are just my opinions. But positive thinking, you manifest the thoughts you carry, and your perception is your reality. If you get in the habit of thinking you're doomed to screw up every single move, you're more likely to do that because you're subconsciously priming your brain to look for failures and to act on them. Be realistic. You are not going to be able to sell the top. There are going to be times where you buy the top by accident, or you sell the bottom, and then the price freaking goes up 30x. It's going to happen. We all make mistakes in the crypto space. None of us hasn't. And we have to view those as the cost of entry and look at them as learning lessons to get better. If this is your first market cycle, congratulations. You've made it to the place where you can make better gains than anywhere else that I can think of. The salary that you get at work isn't going to provide you these gains. The bank account that you put your money in isn't going to provide you these gains. The stock market probably isn't going to provide you these gains. And even if it did, it would take way longer than it does in crypto, with some exceptions, that have occurred in the past when liquidity was just through the roof. But we don't have that kind of liquidity flowing through the markets anymore. So it's really important for you to view lessons as learning opportunities, to accept that you're going to have to lose money to make it. You are not going to get through this market cycle without losing money, without screwing up, but you've got to stick around. You can't just leave and give up. Because if you give up, you're giving up on yourself. You've got to believe that you can make it and you can be part of that 1%. I think you can do it. Do you think you can do it? That's the important question. So, my future risk management videos are going to focus on these three things. Part 2, we're going to talk about market psychology. And this will be stuff that isn't necessarily your individual psychology. We talked about that today, but more to do with how the market functions as a whole, alternating between fear and greed and some other things. Part 3, how do you select risk metrics and do technical analysis? So I'll share some of my risk metrics that I use with you, and then you can look at what I use and go to my Telegram group and talk about what risk metrics you like to use. There is not one single way to do technical analysis. In fact, I would say stay away from doing technical analysis a different way that you've seen if it doesn't make sense to you. You need to find the tools. There are tens of thousands of tools out there, and you can even code your own or have someone code them for you to help you understand and visualize market psychology playing out on the charts. Part 4 is going to be how do you take profits, because it's very easy to DCA into the market, but it's hard to take money out of the market. And so we'll talk a little bit about that. So if you want to see those videos and be notified of them when they come out, please remember to subscribe to my channel, hit the notification bell, like the video if you enjoyed today's content and you're looking forward to seeing the next 3 parts, and comment below with any thoughts that you have. Please join our free Telegram group, The Snake Pit. We've only been doing this for 3 weeks roughly, and we already have almost 150 members there. And this is crypto simulation theory, because the crypto space, in my opinion, is a very brilliant simulation of financial sovereignty. So, financial self-sovereignty. Thank you so much. Again, nothing in this video was intended to be financial advice or professional therapy advice either. None of it. Okay. It's just education, entertainment. And I hope that you learned a lot today and you can apply these lessons to enhance your ability to make gains by trusting yourself, trusting your gut and your own intuition, becoming your own crypto influencer.